Hey everyone, welcome back to the channel. If you're fascinated by the wild world of global finance, you're in for a treat today. Picture this. A massive shift is brewing in the global economy, one that could redefine how money moves around the world. We're diving into the rising role of alternative currencies, the skyrocketing price of gold, and what the numbers are telling us about the future. No hype, no guesses, just the facts, laid out in a way that's easy to follow. If you're new here, hit that subscribe button and ring the bell so you don't miss out. Grab a coffee, settle in, and let's explore this financial roller coaster together. It's going to be a 10-minute ride you won't want to skip. Let's start with the big picture. Money isn't just cash in your wallet anymore. It's a global system that keeps the world turning. For decades, the US dollar has been the go-to currency for international trade and central bank reserves, making up about 48% of global payments and 59% of reserves according to the latest IMF and SWIFT data from mid-2025. That's a huge chunk. But here's the twist. That dominance is slipping. Back in 2000, the dollar held 71% of global reserves, and now it's down to 59%. Why? Well, the world is changing fast, and other currencies are stepping into the spotlight. We're seeing a slow but steady diversification as countries and businesses look for options beyond the dollar. It's not about replacing it overnight, more like sharing the stage with new players. And that shift is sparking some incredible trends we'll unpack today. One of those trends, the price of gold is absolutely soaring. As of October 2025, gold hit $4,142 per ounce, up a whopping 43% this year alone. That's not just a blip, it's a signal. Central banks worldwide, including some major players, have added over 500 tons of gold to their reserves in 2025, with the People's Bank of China leading the charge, reporting 303 tons. Some analysts think the real number might be higher due to underreported ETF purchases, which saw $30 billion in inflows. Gold's rise isn't random. It's a hedge against uncertainty in global markets, and we'll dive into why that matters in a bit. But first, let's talk about what's driving this diversification away from the dollar. So, what's shaking up the dollar's dominance? Let's look at the numbers. The U.S. national debt has climbed to $37.85 trillion as of this month, October 2025, up $2.17 trillion from last year. That's a mind-boggling figure, translating to about $286,000 per American household. On top of that, government deficits are running at 6.7% of GDP, a level that echoes the lead-up to big financial shakeups like the 1970s and 2008. Now, I'm not here to point fingers or predict doom, just to share the data. This debt load is putting pressure on the dollar because it raises questions about long-term stability. Then there's the inflation story. The Consumer Price Index, CPI, is hovering at 3.1% in 2025, above the Federal Reserve's 2% target. Analysts like Mike McGlone from Bloomberg Intelligence suggest it might settle around 3% due to a wealth effect from rising stock markets. But here's the catch. Official data isn't always the full picture. The Bureau of Labor Statistics has faced scrutiny. Think millions of job revisions in recent years. And some are turning to alternative sources like Amazon and Walmart sales data for a clearer view. It's not about distrust. It's about wanting the real story. When numbers get murky, people start looking elsewhere, and that's where alternative currencies and assets like gold come into play. Speaking of which, let's check the markets. The S&P 500 is trading at 2.3 times US GDP, historically high, and volatility has dropped to levels not seen since 2020. That's a quiet surface hiding some big undercurrents. Gold, meanwhile, has broken above its 5-year moving average, a move that echoes patterns before major financial resets. The S&P to gold ratio, now at 1.62, has dipped from 1.5 recently, a trend that technical analyst Gareth Soloway links to the 1970s and 2008. It's not about panic, it's about understanding the signals markets are sending. So, what's filling the gap? Let's talk about the rise of other currencies and assets. China's yuan, or renminbi, is one to watch. Through systems like the Cross-Border Interbank Payment System, CIPS, it's handling 2.9% of global payments, up from 2% 5 years ago. That might sound small, but it's a foundation for growth. The Belt and Road Initiative has pumped over $120 billion in yuan-based investments into countries across Asia, Africa, and beyond in 2025 alone. It's not about dominating yet, it's about building a network. Other nations are following suit, with trade deals increasingly settled in local currencies rather than dollars. Then there's the stablecoin boom. These digital currencies, pegged to assets like the dollar, have a market cap of $250 billion, with projections to hit $1.2 trillion by 2028. They're a bridge between traditional finance and the digital age, offering speed and efficiency. And gold? It's not just a shiny relic. Central banks added 500-plus tons this year, and ETF inflows hit $30 billion. That's a vote of confidence in tangible value amid uncertain times. These trends aren't isolated. They're interconnected, reflecting a world adapting to new economic realities. Segment 4, What the Experts Say, 739 and Human. Let's bring in some expert insights. Mike McGlone from Bloomberg Intelligence points out that the wealth effect, rising stock values, keeps inflation sticky at 3%, even as demand weakens elsewhere, like China's producer price index at 3%. He sees this as a sign of markets outpacing economic fundamentals. Gareth Soloway, a seasoned technical analyst, adds that gold's breakout above its 5-year average mirrors 1980 and 2011, periods before big shifts. He's eyeing treasuries as the next big trade, with early signs of a bottom forming as investors seek stability. Both agree. The current market calm, low volatility at 2020 levels, hides deeper cracks like the 80% gap between gold and crude oil prices, crude at $61 after a $55 low, the widest in a century. This isn't about predicting the end of the world. It's about reading the room. The data suggests a transition, not a collapse. Gold's strength, the yuan's slow rise, and stablecoins' growth are pieces of a larger puzzle. The S&P's high valuation, 2.3x GDP, could signal a correction, but it's not a given. Markets have defied gravity before. So where does that leave us? We're in a fascinating moment where global finance is evolving, driven by data and trends we can track. The dollar's still the leader, but its grip is loosening as alternatives gain ground. Gold's rally, currency diversification, and stablecoin adoption are reshaping the landscape, and it's worth keeping an eye on. What do you think? Will these trends accelerate in 2026? Drop your thoughts in the comments below. I'd love to hear your take. If you enjoyed this deep dive, give the video a thumbs up, subscribe, and hit that bell for more updates. Share this with a friend who loves finance, and I'll see you in the next one. Thanks for joining me. Let's keep exploring this wild financial world together.